I was reading an article on Financial Post this morning, and the title was like, Canada needs to stay on the right fiscal track or risk the bond market's wrath. What does it mean? If you've been paying attention on the government fiscal spending, or if you've been watching my videos, you know that one of the true source of inflation is government fiscal spending. So when government runs fiscal deficit, which means they're not collecting enough revenue from taxes or other sources, but they're spending more money than they're collecting revenue, that means they're running fiscal deficit. And that deficit, if it is growing, it is a concern because that needs to be paid by somebody. If they are not collecting enough taxes, which means they are borrowing money from the market, and that borrowed money needs to be paid back not only on the principal but also in the interest payments, and in the end that overall principal and interest on the borrowed money needs to be paid by the taxpayers. So that's the overall concept of the fiscal deficit, and that is the true source of inflation that we are seeing in this country. So since pandemic, Canadian federal government has been running a fiscal deficit. According to the last fall economic statement that was published back in November, Chrystia Freeland published that we're running $40 billion of deficit currently, but the projection in terms of when we will be bringing that deficit back to normal is being pushed again and again. And right now we don't have a definite timeline when we will see that the federal government will bring the deficit spending back to the normal range, which means basically no deficit spending. So that is a concern. And this article that I just mentioned, they're talking about why this is a problem, because if the government is continuously running deficit, and if you're not a US government, that means you're relying on the bond market to dictate the interest rate. If you read this article, you will realize that they are talking about how the bond market controls the interest rate, because when the government run fiscal deficit, you are basically borrowing money from the bond market, and bond market is the biggest market in the world. It is bigger than the stock market. To some extent, some people say it's 100 times bigger than the equity markets. Okay, so it's a global market, and of course the US Treasury has the biggest pie across the world, but Canadian government also of course contribute into the bond market. So bond market, what is bond market? Bond market is basically a debt market. So bond is basically a loan agreement between the issuer, which means the government or the corporation, and the lender lending the money, like individual investors or financial institutions or hedge fund owners. So when the government runs fiscal deficit, they go out in the market, they issue the bonds, and those bonds are purchased by individual investors or hedge fund owners or pension owners, financial institutions like banks and other corporations. They purchase those bonds, which means they are lending money to the government. Now the interest rate is set by that market, not Bank of Canada. The Bank of Canada can only use their narrative to influence the market, but they don't directly dictate the interest rate of the debt that is being issued in the market. So you would ask that, Yasin, okay, that is between the government and the market participants. How is it going to impact myself? Well, if you are transacting with bank, taking out a loan or taking out a mortgage, or even you putting your money in the savings account, you are being influenced by the bond market, because the interest rate that is being set by the lender, by the bank, in terms of giving out your loan or giving out your mortgage, or even giving you the interest rate on your savings account, it's all set by the bond market. The bond market will dictate the rate that bank will use to pass on to you, because banks make money on the interest rate differential. The takeaway of this article is the fiscal deficit is something that we have to pay attention to. If it is growing and the projections to bring it back to normal is also being pushed out, that's not a good sign, because if the market doesn't trust the government's credibility in terms of bringing the fiscal plan back on the track, which that means the market could downgrade the rating, the credit rating, And if it happens, then of course the interest rate that is being set by the bond market will spike up. A good example is UK last year, when we saw under Liz Truss government, when she proposed her plan, which includes the unfunded new tax cuts. The market did not appreciate that, and the bond market completely blew up. The bond yields spiked up, and ultimately Bank of England has to intervene to save that. So that could happen with any other country like Canada, because if the market loses the trust on the government's ability to bring the fiscal plan back on the track, it can blow up the bond market, which means it can blow up the interest rate. So the takeaway of this article is the interest rate that you and I interact with in terms of loan, mortgages, savings accounts, it's basically set by the bond market, not Bank of Canada. Bank of Canada can use their narrative to influence the market, but it is actually set by the bond market. They dictate the interest rate based upon the risks and the future growth and inflation expectations. If the counterparty risk goes up and the future projection for the growth and inflation goes up, then of course the lender will demand higher interest rate to compensate for any risks that they have to carry for, let's say, 5 years or 10 years or 30 years, depending upon the bond duration. The reason why I'm explaining this to you is because if you are an investor, you have to keep an eye on these things to understand the market dynamics, how the markets are moving, how the bond market is moving, and how this is going to impact you and I in terms of our loan payments, our mortgage payments, our interest payments on the GIC, for example, how this is going to change over time. What are those events that could trigger a downward or upward trend when it comes to understanding the interest rate affected by the bond market? So all of these things are very important to understand for an investor, so you can not only protect your wealth but also grow from here and be successful in this crazy world. If you have questions, put your comments down below. Let me know what you think. And if you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. Thank you.